A $500 billion wipeout. That's what just rocked the semiconductor sector, and it's put the entire AI trade on notice. If you're invested here, you absolutely need to understand what just happened and what it means going forward. Yeah, you're seeing that right. In just a few days, $500 billion in market value just vanished from chip stocks around the globe. This wasn't some minor dip. It was a genuine earthquake that shook the very foundations of the AI rally, and you can bet it has every single investor on high alert. This is the chip market, and we're going to break down exactly what this means for you. So what we just witnessed was a massive, synchronized sell-off. This wasn't isolated to one company or region. We're talking US names like Nvidia, European heavyweights like ASML, and of course, Taiwanese titans like TSMC. They all went down together. And here's the key. The stock prices fell way, way faster than the underlying business fundamentals. AI demand is still there, but the market's entire perception of value, that changed like overnight. Okay, so you've got the context. Let's get straight to the bottom line right up front. First, this was a valuation and sentiment reset, not a fundamental collapse in AI demand. That is crucial. The core AI plays, we're talking data centers, leading-edge foundries, high-bandwidth memory, they still have really strong long-term tailwinds. But the more cyclical parts of the market, commodity memory, some auto chips, they're going to stay choppy. And from here on out, all that policy and tariff noise carries a much bigger risk premium, which all leads to the big question. Is this just a pause, or have we actually hit the peak? Right, so to figure out where we go from here, we have to unpack the why. There wasn't just one single trigger for this. It was really a perfect storm of stretched valuations, rising fear about the AI cycle, and some serious policy headwinds. And this chart, well, it shows you problem number one perfectly. Valuations had gotten stretched to the absolute breaking point. The Philadelphia Semiconductor Index, the SOX, was trading at a forward PE of 28. Now, look at that next to its 5-year average of 22. That gap tells you the market was pricing in total perfection, leaving zero room for error. It was just a classic setup for a major correction. So that overvaluation was basically the dry tinder. Then a few different sparks hit it all at once. We got that swift compression in multiples we just talked about. Then you had fears creeping in that maybe the insane AI demand we've seen was front-loaded. That everyone rushed to buy GPUs and now things might cool off. On top of that, let's be honest, there was simple profit-taking. The stocks was up 45% for the year. And then you sprinkle in that cocktail of macro and policy fears, and, well, you get the sell-off we just saw. And it wasn't just retail jitters. This quote from Morningstar really captures that growing skepticism from the big institutions. That whole "this time is different" narrative because of AI, well, it started to crumble. The message was pretty clear. Hey, even with a game changer like AI, the chip industry has always been cyclical, and we might be getting close to the top of this boom. So this brings us to what's probably the most important thing for any investor to grasp right now, the great divide that this sell-off exposed. It's not enough to just be in chips anymore. You have to be able to separate the segments with real structural, long-term tailwinds from those that are just along for the ride on the old economic cycle. And this lays out that divide perfectly. On the left, you've got the engine room of AI. We're talking the GPUs, the advanced foundries like TSMC, who are the only ones who can really build these things, and the high-performance memory and packaging holding it all together. But on the right, well, that's where you find the segments exposed to the cold winds of the global economy. Commodity memory, older auto chips, industrial stuff that's much more sensitive to GDP and inventory cycles. Let's be really clear on what we mean by structural winners. These are the parts of the market that are riding a multi-year investment supercycle into AI and the cloud. The demand here isn't a flash in the pan. So for long-term investors, the thinking is that these sharp pullbacks aren't a reason to sell. They could actually be buying opportunities. Now, on the other hand, these cyclical pockets are facing a totally different reality. Think your standard DRAM and NAND, or analog chips for industrial stuff. Their fate is tied way more closely to the macro environment, to inventory corrections, and the risk of oversupply. And frankly, this isn't a new story. We were already hearing cautious signals from companies like Texas Instruments even before this big sell-off. All right, so that covers the what and the why. Now for the part that really matters. What's next? Here are the key signals you need to have on your dashboard for the next 3 to 6 months, because they're going to be critical. Think of this as your essential 3-point checklist. First up, earnings and guidance. You have got to scrutinize every single word from the AI leaders and the memory makers for any signal on real demand. Second, you have to track the physical supply chain. Are foundry utilization rates holding up? Are equipment orders slowing down? And third, Policy is now front and center. Any headline about export controls or tariffs can move this entire sector in a heartbeat. And let's be blunt, inside that whole dashboard, there is one data point that matters more than anything else right now, and that's Nvidia's next earnings report, specifically its forward guidance. It is going to be the ultimate bellwether. It will either confirm this whole AI slowdown narrative, or it will completely blow it out of the water. The entire market is waiting for this. Which brings us right back to the central question, the one that every single investor in this space is wrestling with. Was this $500 billion reset just a healthy pause? Something that shook out the weak hands and set us up for the next leg up? Or did we just witness the top of the AI hardware cycle? So now I want to hear from you. Using the framework we just talked about, thinking about valuations, the structural versus cyclical players, which chip stock do you think overreacted the most? Which company got unfairly punished in this whole thing? Drop your pick and your thesis down in the comments below. And hey, if you found this breakdown valuable for making sense of the chaos, do us a quick favor. Hit that like button, share it with another investor, and make sure you subscribe for more essential analysis on semiconductors and AI. Thanks for watching.